Hello and welcome to Journey Towards Wealth. In today's video, let's discuss why is it important for you to have equity in your investment portfolio. Equity investment is basically a share in the company directly from the company or through another investor with the intent to earn through dividend or with the increase in price. Here, you're participating in the stock markets of a country and you're able to purchase a share or ownership in a company. So, as the company starts doing well, as the growth keeps going, and if it's a fundamentally strong company and the company has a good business moat, then it is quite evident that you can be successful in your equity investment. So it is important for you to analyze your company and understand the growth prospects of the company and then make the investment. Many a times people purchase the shares of the company through stock tips or through recommendation by others, and this is the reason when the market falls or when things go against the company, people are not able to hold on to the stocks because they have not bought the stocks according to their conviction about the company. Hence, it is very important for you to actually understand the company and then make the investment according to your risk profile. Now, when you look at stock markets, here your earnings are happening because you buy the stock at lower prices, and when you sell it at higher prices, that is when there is capital appreciation and you make profit. But many a times in short term, the stock market can be volatile and the prices can suddenly come down, and many people lose their patience to hold on to these stocks in that downturn times, and that is where they lose their money. But if you do not sell the shares when the market falls and you are holding on to that share, then you are only in notional loss and you don't need to book the actual loss and wait for the markets to get better and then sell the share and make a profit out of your investments. Now, before we go deeper into why equity should be part of your investment portfolio, let's understand what exactly is this equity or what are the risks associated with investing in equity market. Equity market investment revolves around a basic risk, which is the volatility involved in equity market. Equity markets might go up, it will come down, it will go sideways, it will have all kind of movement in the short term. But if you look at the long term story of the equity market, it has always gone up. So what you understand from this, it is a place where you need to have patience, you need to have conviction on your investment over a longer period of time. The short term ups and downs should be ignored, and once you are aware about the market and the stocks or the mutual funds that you're invested in and you have conviction, then you will be in a position to hold on to that stock without much of a hassle. Now, what generally happens is whenever the stock markets give you a high return, that is when people will start coming to equity market. Those are the times when the stocks would have already performed so well and would have reached the peak. And once you enter at that point, the stock market might be in for a small correction or a crash, whatever be the situation. And that is when the newcomers would be taken aback with the behavior of the stock market because they only have seen the markets going up, and when the markets coming when it starts coming down, it is not a rosy picture. These are the times where if you are aware about the volatility of the stock market or if you are aware about the nature of the stock market, you will be in a position to hold on to the stocks of the mutual fund that you have bought and reap the benefit of this kind of volatility. Now, if you look at Sensex, which was started in 1979, we can see that it has given a compounded annual growth rate of 16% on a long run. But these are not returns that have happened in a shorter period of time. Somebody who would have stuck on with the stock market for this long 40 years would have created huge wealth. So you need to look at stock market in a long-term story of at least 10 to 15 years. That is when you start getting the benefit of the stock market. This short-term ups and downs is part of the market, but The long term story is intact as long as you have conviction on the stocks or the mutual fund that you're holding. Now comes the question, what is a guarantee that you will get this kind of returns in the future? Again, stock market is not a place where you have guaranteed returns. When there is a guaranteed returns, then returns will always be lower. But market is a place where you cannot guarantee returns, but it is a place where you have to enter with conviction that is the growth story of the Indian market. As per SEBI data, around 70 million demat accounts were opened from April 2020. This is just not a number. This shows the confidence of retail investors in the Indian equity market. Strength of an economy is shown by this kind of participation by retail investors. Also, more household savings are getting redirected towards the Indian equity market. Now, if you compare with the US story, we realize that it is between 1980 and 2000, US went from a $3 trillion economy to a $10 trillion economy. And if you look at the retail participation or the investment participation during that time, you realize it went from 3% of the population to 50% of population between 1980 and 2000. And if you get actually reflect this on the Indian story, we realize today India is at $3 trillion economy. And if you have more retail participation coming as India progresses to be a $10 trillion economy, then you can imagine the kind of growth that we are waiting for the Indian equity market. India is home to 1.3 billion people with average age of 29 years, which makes it one of the youngest population in the world. As per United Nations Population Fund, India can create a demographic dividend, which is a shift in the population structure where you have larger number of people working rather than dependents. And this could be the strength of Indian economy, and this would take India from a $3 trillion economy to a $5 trillion economy. The younger earning population with less dependence is having higher disposable income, which will come up as a new category of buyers. Companies are bringing up new products and services according to the pricing requirements of this generation. Also, with higher spending power, this will actually revive the Indian consumer market, resulting in higher economic activity. Around 62.5% of working population between the age group of 15 to 59, India is all set to benefit from this demographic advantage till the year 2055. India has young and educated youth coming up in the generations to come, whereas many of the countries in the world are facing a shortfall of working population due to lower birth rates and aged working population. Many global companies are actually looking at India as a market for its products and services because of this educated young population. Also, India is all set to emerge as one of the leading consumer economies of the world. To participate in this growth story of India, there is no other option other than participating in the equity market of India. So, if you're somebody who believes in this growth story of the nation, there is no other way for you to reap the benefit of this growth story other than participating in the equity markets. And this is one reason why it is important for you to have an allocation towards equities in your asset portfolio. Many experts suggest that India will become a $15 trillion economy by 2035 to 2040. And it is this growth that you're betting. And if you're ready to wait and if you have the patience and conviction in the stock market of India, this is the best time to invest so that you can reap the benefit of this growth over the next couple of years. Again, you should remember that stock market investment is not for weak minds. Also, it is not for a shorter duration. You need to give at least 7 to 10 years with patience and conviction so that you can reap the benefit of this growth story in the years to come. The next reason why you should invest in equity market is because it is one of the very few assets that can beat inflation by a good margin. Today's inflation is at around 7%, and equity market over the past 40 years have given you a annual growth rate or a compounded annual growth rate of 16%, which is way above the inflation that we are talking about. Again, we need to understand that inflation is a constant worry for all of us. Inflation is eating away our savings over a longer period of time, and unless you have an asset class which can beat it by a comfortable margin, you will not be able to accumulate wealth over the next couple of years. Here, one thing you need to notice is equity investment is long term investment. And unless you have a patience to wait long term for a period of more than 7 years, it cannot be part of your asset portfolio. So, if you have somebody who have patience to wait for 7 to 10 years after investing, then this is an asset class which would give you a return that can beat inflation by a comfortable margin. And hence, this should have a place in your asset portfolio. So, the next reason why you should have equity in your asset portfolio is if you are somebody who is looking for wealth accumulation or appreciation of your investment, then you cannot ignore equity, because this is one asset class which has consistently overperformed other asset classes over a good margin over a longer period of time. Only condition that you need to adhere here is you should have a longer period of time, and you should be able to adjust to the volatility of the market. Once you are ready for both of this, equity market is the place for long-term wealth creation and capital appreciation over a longer period of time. Another reason why equity should be part of your investment portfolio is because of the dividend that you're receiving from the companies that you're invested in. Many a times, dividends could become an additional source of income, especially when it comes to your retirement. It can be a source of income which will help you to actually tie through your retirement age. Many people think of equity only in terms of wealth appreciation, but if you're invested in good quality companies over a longer period of time, this dividend that you receive from the companies can be a good source of income on a regular basis. This is another reason why you should look at equity as an investment option. When it comes to creating an asset portfolio or an investment portfolio for yourself, it is important that you have diversification in the asset classes that you have in your investment portfolio. It is not wise to keep all your investment in one particular asset class. Also, it is important that we have your money across different asset classes, because each asset class has a purpose of its own. Basically, if you look at an asset class like your PPF or your fixed deposit, it is basically for protection of your capital. Whereas when you look at real estate or you look at equity, it is mainly for wealth accumulation or increase of wealth over a period of time. So it's important to have all these assets allocated in your investment portfolio. Now, when it comes to equity, many people believe that it is okay to ignore equity as an investment in your asset portfolio. But if you're somebody who is looking for accumulation of wealth over a period of time, then you cannot ignore equity in your investment portfolio. Equity is one investment which will help you to actually increase your wealth, or which will help you to accumulate wealth over a long run. So, when it comes to diversification, equity has a major role to play in your investment portfolio. Having gone through the reasons why equity should be part of your investment portfolio, we should go through some points which are important for you to keep in mind. First and foremost, equity is for long term investment. If you're planning to invest only for 1 or 3 years, then equity is not your place. For shorter term, you should look at some other investment option. But if you're looking something for a longer period of time with good returns, then equity is your place. The second point is volatility is part of equity market. In a short run, market may go up, down, sideways. Anything can happen. But in the long run, market will help you to get a decent double digit return. And that's what you should be aiming for. Third point is there may be years of underperformance. There may be 2, 3 years when the market would not have given you any returns, or rather, it would have given you negative returns. But a fourth or a fifth year will come when the market will compensate for all your losses over the previous years. Hence, patience is a virtue at this point of time. If you're somebody who gets frustrated with losses happening in a year or two in the market, then market is not your place. Then it's better that you do not enter equity market. But if you're somebody who has conviction on the market, on the stocks that you have invested or the mutual funds that you have invested, and you're ready to stick on, then you can enter equity market. The fourth point is you should not keep tracking your investment value on a daily basis. There are maybe months when you may not have any return from the market. And if that's going to dishearten you, then equity market may not be your playground. Then it is better that you look at other investment options. Another question is how much should you allocate towards equity? Actually, the thumb rule says it is 100 minus your age, which is if you're somebody who's in your 30, then you can allocate around 70% towards equity. But according to me, it doesn't work that way. It is basically your comfort level with the market, which should be your deciding factor. If you are somebody who gets sleepless nights with the volatility in the market, then you should not have higher allocation towards equity. But if you're somebody who's comfortable with equity, then you can have a higher allocation towards equity. Let's say, for example, you're somebody in your 60 and you have been investing for the past 35, 40 years of your life in the equity market and you're quite comfortable with the volatility of the market. Then I don't think there is a reason just because you're 60, you should allocate a lesser percentage towards equity. Because you are comfortable with the volatility of the equity market and you know for a fact that equity will always give you good returns in long term and you're there in the long term game, then just because your age is 60, it cannot be a deciding factor. Even if you have 80% allocation, it's fine because you are comfortable with that allocation. I hope this video is helpful, at least for many of you. Thank you so much for your time. Please like, share, and subscribe to this channel if you find this useful.